Assalamu alaikum wa rahmatullahi wa barakatuh. Alhamdulillah wassalatu wassalamu ala rasulillah. So we'll start the first chapter of our course, which is credit from conventional perspective. So in this chapter, we'll talk about what credit is, what is the nature of credit, and then we talk about what are the benefits of credit, what is the role of credit in an economy, and then with the lot of benefits attached to the credit, there are also some disadvantages that we need to be aware of. So let's see what is credit. So credit is a Unani came from an Unani language. The root word was credere, which actually means trust. So the very basic component of credit is trust. Why is it trust? Because a borrower cannot borrow something if the creditor does not trust him. So the element of trust is so important. If I ask to borrow some money from you, you may give me because you trust me. If you do not trust me, you will not lend me the amount. So the basic element of credit is trust. So that is the literal meaning. That is the literal meaning. So let's see what is the technical meaning of credit. So according to Joseph, credit is a transaction between two parties in which one, the creditor or lender, supplies money or monetary equivalent goods, services, etc., in return for a promise of future payment by the other, the debtor or borrower. Such transactions normally include the payment of interest to the lender. So here we can see the technical meaning is quite similar to the literal meaning. His credit is just opposite to cash transaction that we'll see later on, where someone buys something, okay, purchases something, okay, and he gets the goods or services, okay, on the spot, okay, but in return, okay, in cash payment, usually the person needs to pay on the spot, but in credit, the person, instead of paying cash, he will give a promise, okay, in return for a promise of future payment, that the payment will be made in the future, which is not made on the spot. Rather, there is a promise given that the payment will be given on a later date. So that is with that actually the credit is created. The credit transaction is created. So so this credit, okay, it has some characteristics, okay. So actually this concept of credit, it date backs to many years ago when when they used to travel from one country to another, so they used to be afraid of carrying cash. So what they used to do is they keep their money, okay, they keep their money with banks, okay, or with and then that bank used to give them a certificate, or which can be called as check. So that check represent actually that this person, okay, put some money with this bank, and this bank is something like indebted to that person. So that type of certificate, okay, used to be used to buy or to purchase some asset. However, this used to have a limited acceptance. It cannot be accepted. So similarly, a debt, for example, a debt instrument like government bond, okay, if you purchase a government bond or corporate bond, that actually represents that the government or the company owes you, okay. So that's actually a document representing credit. So with that certificate, someone may be able to buy something, okay, but with a limited acceptance. Maybe, for example, the Malaysian government bond can be accepted only to limited number of vendors in Malaysia only. Okay, so I will say it is a medium of exchange with limited acceptance that may not be accepted. accepted anywhere. And then this credit facilitates the transfer of value from buyer to seller, okay, but it is not available to everyone. So with this credit, okay, the certificate of debt, okay, we sometimes we can purchase something, okay, we can the value or the asset, okay, okay, it will facilitate the transfer of value from the buyer to the seller, okay, but it is but means this is not available to every, so it is only to a limited number of buyer and seller who accept these facilities, okay. So that is the what's the credit is. So to be more clear on what is a credit, okay, so here we see what is a cash transaction, okay. In a cash transaction, say here we have a buyer, okay, and then we have the seller, okay. So when the buyer wants to buy something, okay, so the seller will deliver the goods and services, then immediately the buyer will transfer the cash to the seller. So this is a cash transaction, which is opposite to credit. Okay, now if we see the credit transaction, okay, so here we have purchaser and seller. So now the seller, okay, delivers goods or services. He provides the goods or services. Then here, okay, the purchaser, instead of paying on the spot, he promises to pay. The purchaser promises that he will pay on a later date. So on a later date, the seller will make a claim that, okay, that the purchaser, he promised to pay on this date, and then at that day the purchaser will make the payment. So this is how the credit transaction happens. Okay, so from this example, we can see that there are four important elements, okay, in credit transaction. The first is trust. In order to do transaction on credit, the seller must trust the buyer. Okay, somebody will not easily sell something on credit if he does not trust the person. Okay, so that's why the banks, the financial institutions, they also do a background check or evaluation in order to have trust on that customer. And then another element is that it should be a deferred payment. Okay, if the payment is on the spot, then there is no credit anymore. Okay, so deferred payment means that the payment will be made at a later date. Okay, so then it is the creation of credit. And then there is cost for it. So this is from conventional perspective, that when somebody provides credit to you, you need to so somebody is like giving you a facility, so you need to pay for that. Okay, so that is actually the cost of credit is interest. Okay, as you learn from your conventional economics, that cost of fund, which is interest. So where you are, because you are getting a facility or service on the spot, okay, but you will pay for it in a later date. So you got this facility, so you need to pay for it. So that's the conventional perspective. Okay, but we'll talk about Islamic perspective later on. And then finally, there is an element of risk. Okay, even though the creditor gives credit, a loan to the debtor, okay, with the trust, but there is an element of risk. What kind of risk? The risk that the debtor may not be able to pay back. Okay, so that is we call the risk of default or credit risk. Okay, that there is a probability or possibility that uh, that the borrower will not be fulfill his commitment. He may not be able to pay back. So these are the four important components of a credit transaction. Okay, so now we look at the role of credit in a financial intermediation process. Okay, so in an economy where there is a financial intermediation, where the money is rotating from one unit to another unit, so what is the role of credit there? Okay, so you can see this is the our society, our economy. So at my left hand side, there is surplus unit, where there are some households or families, some business firms, governments. Okay, they have surplus, they have saving. Okay, they have surplus amount of money. So then at my right side, there is a deficit unit, where there are some households. Okay, they need cash. Some business firms, okay, they need cash to maybe extend their business. Okay, sometimes, and then even the governments also, they lack of cash. Okay, sometimes they need fund, okay, to make big projects. So if we so what is the role of credit in between the surplus and deficit unit? So mostly the surplus unit will provide, okay, fund, okay, provide fund to the deficit unit through credit. Means those who have surplus amount of money, the household that has surplus amount of money, okay, they will give loan or credit to the deficit unit, so that the deficit unit, they can make do businesses, for example, or they can fulfill their needs, and then they will pay back to the surplus unit plus some kind of cost, okay, compensation, which is the interest. So this intermediation, okay, in an economy may happen in two way. One is the direct financing, another one is through indirect financing. So if it is done through financial markets like capital markets, okay, or money markets, so then we call it direct financing, where the deficit unit will meet the surplus unit directly. However, if it is done through the banking institutions, so our focus is on banks, so it is called indirect. So where bank will be an intermediary, where bank will take money from the surplus unit, and then bank will give loan or credit to the deficit unit. So so we can see the importance of credit, okay, for an economy to grow. So if there is no credit transfer, there is no, if the surplus unit does not give credit to the deficit unit, so the economy cannot grow. The business firms, those who need fund to extend their business, they cannot do that. Okay, the households who need money to buy car or houses, for example, they cannot do that. Even the government may not be able to make big projects if it cannot get uh, funds from the surplus unit. So for an economy to grow, to a country to develop, credit is very much important. It is it is crucial for an economy. So now we'll go detail of this, each of these, how unit of the deficit unit, how they are actually benefited from the credit. Okay, so let's say we can divide them into four types. Okay, okay, we have consumer purchases, let's just normal retail individuals, okay, we purchase. And then for trade business, and then for corporation finance, to finance big corporations, and also government spending. So how credit, so we'll go in detail of how these four segments, okay, of an economy, okay, how they are benefited through credit. So first, let's look at the household spending. Okay, how the families, the households, how they use credit, why they need credit. Okay, so individual households use loans or credit financing to make current purchases, such as a new home or car. So they need credit to purchase things. For example, a house. Okay, you see, usually uh, uh, in Malaysia, for example, a house is 500,000 or millions. So those who are, getting earning by salary, okay, those who are government employees, for example, they are not able to buy the house at once with cash. So they need some kind of financial help. They need credit. Okay, so we can see how important is credit for them. Can you imagine if the banks do not provide credit to people? What will happen? Maybe 90% of us will not be able to have car. Maybe 80% of us will not be able to buy house at the beginning of our career. Maybe we'll be able to buy at the end of our career, or when almost we are going to retire, almost close to the grave, for example. Okay, so car buyers usually, so this credit has different. There are different kind of contracts. It can be like hire purchase. It can be other just direct borrowing and lending. Okay, so for conventional, usually car buyers usually use hire purchase facilities. Okay, hire purchase means lease ending with sell. Okay, in a conventional perspective, hire purchase is actually a loan. Okay, where if somebody um okay, takes a hire purchase facility from a bank, it means they actually taking a loan. And then credit is also available in the form of overdraft and personal loan, as well as credit cards. Okay, so many of us are familiar with credit cards. Okay, so credit card is something where we can purchase things that we want with using the credit card. So when you use the credit card, the bank will pay on behalf of us. So we are actually borrowing from the bank. Similarly, personal loan is for just usually short-term financing, and for small house needs, like to repair car, for children, tuition fees, okay, for marriage, for example. So people also need this type of personal loan from banks. Okay, and also overdraft is a kind of facility where people will be able to withdraw money from their account even though they don't have money in their account. Wow, this is excellent. Okay, so this type of facility is given to certain kind of individuals who on whom the bank has trust. Okay, so or let's say if someone has a very good job, and he has a very good background of paying back on time, so the bank may consider him to give a facility of over 5,000. Overdraft facility means that even though he does not have money in his account, he would be able to withdraw up to 5,000 from his account, but provided that he has to pay interest for that. So these are the example of how credit is used, or how the households they get benefit from credit. Okay. And then this by extending credit, lenders hold legal claims. So this is from the legal perspective. Okay, the how the feature of credit here. So when the different households, when they buy something, okay, by taking credit, okay, so what does it mean? Okay, so by extending credit, lenders hold legal claims on interest. So the lender, let's say the banks, financial institutions, they hold legal claim on interest. From conventional perspective, the lender has a legal right to get the interest, and the principal loan means the original amount, while borrowers will claim ownership of the asset once debt obligations are fulfilled. So once the the borrower pays back, so he has the right to own the asset. However, financier will take possession of assets when debtors fail to pay up for the assets. However, if the debtor is not able to pay back, okay, the loan given by the financier, then the financier has the right to take back the asset given. Okay, so this is the detailed meaning of the credit. Okay, when somebody buys something, okay, by credit, let's say by taking loan from a bank, so it means from legal perspective, or to generally understood that okay, this is a commonly understood from legal perspective. Okay, so now from a household, okay, we go to trade financing. Okay, how the trades, the businesses, what kind of benefit they get through credit, why they need credit. Okay, so some companies' current cash requirements may exceed available funds, and they usually resort to credit to finance any shortfalls. You see, companies they have a lot of transactions. They buy things and then they sell it. They get profit. So it may happen that sometimes their sales are down, but they need to buy a lot of raw materials. So it may happen that in their account they are lacking liquidity or their lack of cash. They need more cash. So then a number of short-term credit avenues are available for companies usually to be paid within a year or less. So for businesses or some kind of credit facilities are given by the bank. So that all we call the banks, they call it trade financing. And mostly these are short terms and they are unsecured, means a financing which is not given on the basis or with something taken as a collateral. Okay, most of these credit avenues are unsecured. Okay, so there are two types of financing, or okay, one is called secured, another one is unsecured. Okay, secured means when financing or loan is given without any collateral, without any security, okay, or without any arrahnu, okay, or pledge, then that is called unsecured financing. Okay, for example, credit card is given without any security, for example. Okay, for banks, for businesses as well, uh, these some of the trade financing facilities are given based on their record, based on their financial stability, based on their financial strength, but without any collateral most of the time. Okay, the borrower is not required to place any asset as collateral. They are not required to provide any asset. Okay, unlike the household financing. If you for a retail customer, a normal person, if he wants to buy a house, that house also, will be kept as collateral. Okay, if he buys a car using credit, so that car also will be put as collateral. But however, in trade financing, the loans are given away based on company track record and reputation, based on their track record of many years, their reputation, and also maybe the financial situation, economic condition, and some others. So what are the type of products given? One of them is trade credit. So this is the trade. What is trade credit? Using an open account, many companies buy on credit. The credit terms are stated on the supplier's invoice. So many businesses, okay, they are given the facility to buy things on credit. Okay, even we can see example like sometime the gardenia, for example, they provide bread to shops, and then those shops, the retail shops, grocery shops, they will sell first, and after that they will pay back to gardenia. So this is a common practice. So similarly, in business, in big businesses also, this facility is given. Okay, so this is a facility. Okay, so that especially the small businesses or grocery shops, for example, they are benefited from big businesses. And then number two is promissory notes. Okay, so this is from the bank, a term loan with maturity of 30 to 90 days. So this type of loan is given mostly by the bank. Sometimes it's just for a short time of 90 to 30 to 90 days, and mostly for international trade. Okay, when a person wants to or a business, a company wants to buy something, okay, from overseas, so usually the bank will provide them credit. So that's the promissory notes. And then revolving credit or overdraft, as we said, overdraft is the facility to withdraw money from the account more than okay, even though there's no money in the account. Same is the revolving credit. So revolving credit, overdraft, and credit cards is quite similar actually. Okay, so it is a facility to withdraw from account with, but there is a limit for that. Okay, and with of course payment of interest. So banks provide a guaranteed line of credit and charge interest over the amount utilized only while imposing a minimum fee on the unused balance. So usually bank, because of this facility, they will have the bank will charge a minimum fee for every month if the customer does not use it. But if the customer uses the fund, then they will charge interest on that. Okay, with the revolving credit, there is also trust receipt. So this is also for international trade mostly. The bank pays the purchasing company on the purchase order made using the trust receipt. The payment constitutes an interest-bearing loan made to the purchasing company. So when one company wants to purchase something from another company, so the bank will pay on behalf of that company, okay, on behalf of this buyer to the seller company, and then this buyer, okay, will pay to the bank on a later date. Okay, so this trust receipt sometimes quite similar with the promissory notes. So these are for short term, and it is and sometimes also this credit, okay, they are also this certificate of credit are traded in the market. So this is how the businesses they are benefited through credit. Okay, so now we go to corporate financing. Okay, as you know, corporations are big companies. Okay, the corporations are big companies that can be listed in Bursa Malaysia. Okay, in capital market and share market. So these big corporations they also need credit. Okay, large companies or corporations use debt as a part of their overall corporate finance. They can obtain bank loans or raise funds via the securities market. So these big corporations, one way to get credit is through bank lending. Okay, so that we just it can be similar to maybe trade financing. Another way they can get credit is through direct way, which is through the securities market, through the capital market. Okay, now through the capital market, there are actually two ways they get funding. One is they issue share. Okay, they will issue share, and then the shareholders they will pay money, so they will be the owner. Another way to get, raise fund is through issuing bonds. Okay, so they will issue the certificate that represents, okay, that the company owes to these people. Okay, so those who buy the bond, so they will be the owner of the bond, and they will be the creditor to these corporations. Okay, so now, okay, the choice to issue bonds or equities usually depends on many factors, such as the level of interest rates, tax rates, and ownership interest. You see, there are difference between share and bonds. So when the company issues shares, so the shareholder will have a voting right. They will be able to vote for the company. So they will make decision for the companies. So there is a conflict of interest. Maybe the existing shareholders, they don't want it. Okay. So in that case, they will not issue share, rather they will issue bond, because bondholders will not be able to vote. Okay, they will not play any role in the management. However, for bondholders, for bondholders, their interests are fixed, okay, and they will be paid before the shareholders. So, and also there are sometimes, there are different incentives on different tax law. Okay, for example, for dividends income, there is maybe tax, but for bonds, there is no tax. Okay, and also the interest rate. Sometimes the interest rate is lower than maybe the dividends, for example. So because considering these factors, the corporations they decide whether they will raise fund through shares or through bonds. Okay. So if this corporation, if they issue bonds, so actually they are taking loan from the public mostly. Okay, so using bond is actually taking credit from the public. Now, how about the government? Okay, how the government also gets credit? Okay, so the government usually issues fixed income securities, or we can, to make it simple, the bank also issue bonds. Okay, bonds is a certificate that the government will issue. So those who will buy these government bonds, so they actually giving credit to the government. So when we can see mostly when the government wants to make a big projects, okay, like airports, okay, so they will the government will issue bonds, or we can call it fixed income securities. Okay, so because the bonds, they mostly pay a fixed interest, okay, mostly on a semi-annual basis. Okay, so the proceeds are used to finance government deficit spending. So proceed means that the money got from the issuance of the bond, so that is used to finance government deficit spending. So it's not most the bond are issued not only for, for projects, sometimes to for the government's operating costs, like to pay the salary. Okay, sometimes the government may have a deficit, but the salary of the government employees are always on time. So sometimes the government offers, okay, fixed income securities. Okay, and there are different types of bonds that you'll know further in Islamic capital market, okay, or money market. So some are, very liquid, which is the called the treasury bills, okay, and short term. Okay, short-term securities such as the treasury bills are zero coupon bonds, while those with longer maturities have coupons as interest rate payments. So usually the treasury bills are very famous, okay, and the US government's T-bills, okay, they call T-bills. So they are the most famous T-bills in the world, and also secured. So the governments, they use these T-bills for short-term financing, to get credit for short-term. So these treasury bills actually they it does not pay interest. Okay, what they do is they are sold at discount. Okay, means that the certificate value is 1,000. Okay, the T-bills value is 1,000, but it is sold as 900, for an example. Okay, means that at maturity, let's say the maturity is 3 months. So if you buy this T-bill where you will pay, okay, the certificate says 1,000, but you pay now, you buy it 900, means it is sold at discount. So you pay 900, so after 3 months, you can redeem at 1,000. So that 100 you will be your profit. So this is called the treasury bill that is sold at discount, and it is zero coupon. Zero coupon means it doesn't pay any interest. However, for long-term bonds, okay, securities like 5 years or 10 years, so this type long-term bonds, usually they will pay interest on annual basis, or maybe on biannual basis. So this is how the government also needs credit, and government, okay, raise fund using the through credit. So we can see from this all this okay discussion that how credit is important for the government to run smoothly, to run the operating costs. Okay, if there is credit, is like we can say is a blood. Okay, it's like how blood in a human body. If the blood stuck, human being can die. So similarly, the modern day economy, okay, the country cannot move on. It can maybe suddenly stuck if there is a no transfer of credit. Okay, the government may fail, the businesses may fail, and then the households also will fail difficulty. Okay, so there are a lot of good things in credit, but we need to be careful as well with the credit. Okay, along with all the benefits, credit may be dangerous for an economy if it is not used wisely. So if the credit is not used wisely, then it can be very bad. So you can see the financial crisis in US in 2008. Okay, the crisis happened because of mortgage, a lot of defaults. Okay, where people fail to pay their house loans, and then the great debt crisis happened because their debt went too much. So when the debt is too much, and the debt in US, why was the root cause of that crisis? Because the loan or credit is given to some people who are not they are they call it subprime, means to people who are not actually according to the standard, they are not able to get loan or they are not able to get financing, but they are given. Okay, so even though they are not able to pay back or they don't have the capacity, they are very risky borrower, but they are given and then they fail. So if the credit is risk is not mitigated well, so it can be very risky, and it we can see and from the financial crisis in US how bad it can be. And then from a macro perspective, okay, if is a household debt is too much in a country, that can be also dangerous, okay, for the economy. If all the people started to pay back, so it will lead to crisis. For example, in Malaysia, okay, there are a lot of warnings because the household debt is already for 80% or more than 80% of the GDP. So which really uh, uh, mm, which really giving a warning sign for the government of Malaysia. And then we have recently got news that some of the rating agencies, they downgraded Malaysia. Okay, so this is not really good, the rating of Malaysia. So because of one of the reason, maybe the debt is more to a lot comparing with the GDP. And then in a personal level also, the credit can be bad if we do not use it properly. One of the very common disadvantage is that overspending. Okay, when people have credit card, they tend to spend more, okay, than those who buy on cash. So there are many more. Okay, so the conclusion is that credit is important, it is needed, but it should be regulated. It should the credit risk should be mitigated, and it should be keep in control. If it is too much of it, like as you can see in the picture, they can fall down anytime. Okay, so that's all for this chapter. So this chapter already discussed what is a credit, okay, the definition of the credit, and then what is the role of credit and in an economy, how the credit is important for the rotation, okay, of money from the from the surplus unit to the deficit unit, and how credit is important for households, businesses, uh, and corporations, and also uh, the governments. So for your further reading, you can read okay, Bank Lending and Assessment and Management by Koo is in 1995, and also Consumer and Commercial Credit Management by Cole 1992. Uh, so that's all. So I thank you for listening.